Hello, everyone. How you doing? I just realized I have to do something real quick. This is, I'm going to look down when I should be looking up. So let me just fix this real quick. All right. I think that's better. How's everyone doing? Been about a month, long time no speak. Anyway, I thought I'd come on here and talk about a few different stocks, some that I've talked about in the past. And actually, I have a couple new ones I'm going to talk about. And I'll take anybody's questions, all 9 of you. And thanks for coming out. So let's start with Groupon. I think I talked about a month ago, very briefly, after the convert happened, but I can't remember if I did. The convert happened at the end of March, and I did a YouTube at the end of March for IDASL and BMRT, but I'll repeat a little bit what I said about the convert then. If I did discuss it, I'll just say the same thing I would have said, I guess, is that there's 2 signals there. One was that the convert that's outstanding expires or matures, excuse me, in April of 2022. So if they didn't refinance that by April of 2021, it would become a current liability, and no company likes to have current debt. So they had to refinance it. And all they did was refinance it for pretty much the same amount of money that was outstanding. So it truly was like a refinancing, not a opportunistic capital raise. And based on the way that they hedged the transaction, it won't be dilutive until $105 a share versus Groupon was trading at the time at 57 or 58. And they're only paying a 1% interest rate on that debt on top of that. So the reason why the stock went down so much and hasn't really recovered is it's clearly a signal that there's no M&A activity that's going to happen in the near term. If there was M&A, of course, they wouldn't be doing a convertible deal. That said, there's still many reasons to believe that M&A can happen in the next 6 to 9 months. And I'm going to go through just a few reasons why I think that's still very much in play. So the first reason is that there has not been a single insider trade since last June, when the former founder and chairman bought $5 million worth of stock. There hasn't been a sale or a buy, and it's pretty rare for a tech company not to have any insider sales, especially when the stock's more than tripled. So the window was open for them to sell stock after the stock went to 65, 63. And you didn't see any insider sales. Now, the top 5 employees here, specifically the CEO and the CFO, they didn't own a lot of stock. They're new to the jobs, and that could be partially the reason why they didn't sell, though the CEO now owns, I believe, over 200,000 shares, and which is worth, of course, over $10 million, plus other options on top of that. So he could have taken some off the table in the low 60s versus it trading at 18, 20, 22 in the fall. And I would have thought even just a director or somebody would sell 100 shares, 1,000 shares, whatever, to tech company. And there was no trades. So that's the first reason why I still think there's a chance that they are in some sort of quiet period situation regarding a process. The second reason is that we are now 14 months or 13 months into the interim CEO being named at Groupon, who I like a lot, and I think Wall Street likes a lot. And they have yet to name him a permanent CEO. And there's not a really good explanation why they would not have named him as a permanent CEO at this point. They're clearly not running a management process. It doesn't take 13 months. And they've sent Aaron out to do conferences and to do fireside chats with sell side. So it's clear that he's in charge. And the only reason why you don't make him a permanent CEO is if you're trying to save money, giving him a big stock grant or different change of control or what have you, there's no really good reason to have this guy still remain interim CEO if you're planning on making him a permanent CEO at some point in the future. I still think he's made permanent CEO in the next couple of weeks. If he is not made permanent CEO by the time Groupon reports, which is May 6th, then I would, again, double down on my theory that there's something going on here, that it just doesn't make any sense why they would be holding this back. And I wouldn't be too concerned about the convertible deal as a signal that all M&A is off the table. The other thing that's interesting here is that there was an activist back last year, and in January of 2020, they signed a standstill with the activist. It's not a traditional activist. It's kind of fundamental investor that you just decided to get involved after they lost a lot of money on the stock to try to take over some power with the board. And they got the agreement they signed was they got to be able to supervise the board without actually having a voting seat. And he left in April of 2020. I discussed all this in a previous Groupon video, which you could find on my channel. But he left in April of 2020, and he hadn't sold any stock until they filed a 13D amendment in end of March, I believe, and saying that they sold some stock after it went to into the 60s and the 50s. They also bought more in February ahead of the earnings. So I don't know if he's exited completely or if he was just selling the stock that he bought as a trade in February, but he hasn't been privy to any inside information since last April. He's not been on the board or had any kind of access to the board. So I don't think that he has any great insight into what's going on with strategic situation either. But of course, you don't want to see people selling that might have some opinion about where they are in that process, if there isn't even a process. So that all being said, I have to repeat this. I do not own Groupon because I think it's going to be sold or there's going to be any kind of strategic thing that happens. I own it because I think there's a great margin of safety here and a very likelihood of it doubling over the next 12 months because of the two-pronged factor of it being a reopening stock and of the transformation that they are undertaking with the huge cost cuts, coupled with the change in the way that they're handling their suppliers, where they can now offer goods and services, mostly services, at not bargain basement prices, but things that can actually get repeat customers, and then also offering a full suite of their products. So you can see all about this if you go to Groupon's last presentation and you listen to the conference call. They explain, or any of the fireside chats, what they're trying to accomplish. But what I think is really interesting about Groupon right now is that when they reported at the end of February, it was just at an inflection point with the locals markets opening up around the country. And if you look at open table data or hotel activity, you could also look at some of the TSA data, but this isn't as important for Groupon as far as flying goes. And also, Google releases activity data based on people's watches and stuff. They can figure out how many people are moving in a given city or just mobility. And there's a website that posts this every few weeks. I'll tell you what it's called right now. The website that posts this is called Calculated Risk, and I will send the link right now to the blog post. And it appears to me that starting, and someone else, by the way, brought this up to me, so I give credit to a friend. I didn't notice this, but it appears to me that starting March 1st, you've seen a big surge in activity from a reopening perspective. And I don't think that was contemplated in Groupon's Q1 guidance. And I don't think the street has updated Q2 guidance or Q2 estimates to account for what I think is a surge in local activity in many cities around the country. I got to say, for California in particular, not only are we reopening more than we've ever reopened since COVID hit back in March and San Diego, but the governor has said in June they will go away with all restrictions. And it's because California's been such a good job with vaccinations, and we have such a low virus number right now. And I don't see, based on what happened with the seasonal patterns of COVID last year, and of course the vaccinations make it a whole different ballgame, but I don't see another surge happening in California anytime soon, if ever, based on the vaccinations. You never know what's going to happen with strains and so forth. So I think you have an interesting trade with Groupon here, and I made it much bigger over the last a couple weeks, where I own not just more common, but I also own a variety of call spreads. And if you look out to, whether it's July, October, December, or January, you now have a ton of opportunities to put on upside call spreads. I like call spreads versus the calls. It's just how I am for most stocks, but it's kind of defined risk reward. And then as the stock goes higher through my call spread, I naturally get smaller in the name because my delta goes down as it goes higher. So if you look at, I put on like October 65, 75 call spreads. I think I paid like $1.30 or $1.35 for that. I put on December, or maybe there was October 60, 70s, excuse me. And then I put on December 65, 75s for very cheap. I think it was like $1.20 or something. And I own January 80, 90 call spreads. Those can be had for like 75 cents or 80 cents. So you're getting 12 to 1. And the way I see it play out is over the next, 6 months, every quarter from here on out should be accelerating on a quarter over quarter basis. I don't see anything but tailwinds in their locals business. And then if they can actually succeed in the transformation, then you will have a real top line revenue growth story that Groupon's never had. For years, they have not been able to add, bookings. And I think that that's going to happen in a kind of a big way over the next 4 quarters. The last data point I'd like to highlight is I track Groupon jobs posted on their website. And over the last 3 months, open jobs have gone up 50%. So back in January, the end of January, there were 97 jobs. In the middle of February, there were 109 jobs. In the middle of March, there was 121 jobs. On April 6th, there was 143 jobs. And now there is 157 jobs posted. And I think that's pretty significant. This is not a seasonal business. If it's seasonal, it's quarter 4. Quarter 4 has the largest goods quarter and then service quarter. But for the most part, it's just not a seasonal business. And if anything, this is the weaker quarter. So for them to be ramping hiring like this, given how much they fired over last year to get their cost structure in place, means that they must be seeing signs of a pickup, or at least signs that they are accomplishing their transformation, where they need new jobs to support the transformation. So you don't usually have a ramp up in hiring like that if things aren't going well. So yeah, I feel pretty good. I didn't feel good about Groupon into last quarter. I thought last quarter wasn't going to be good because of everything being shut down, and I was way wrong there. And this time I actually feel good about it. So who knows? I could be wrong again. But with the stock having retreated all the way back into the 40s from the lower 60s, I think your setup is much different than it was a month ago. So that's Groupon. I'll take any questions to Groupon at the end if you guys want, or anything now. I like it. The valuation is not demanding at all. You're looking at, I like to call it the balance sheet being net neutral. They have a lot of cash. They have less debt than cash, but they also have liabilities from a merchant perspective. So you're kind of looking at a $1.4 billion market cap, enterprise value, and stock-based comp has come down dramatically. So your stock-based comp annually is maybe 40 or 50 million, and your adjusted EBITDA, not counting for stock-based comp, could easily get back to the $250 to $300 million range next year on a $1.35 billion market cap. Free cash flow should be, significant with, no taxes, of course, and not a huge CapEx spend either. So you could easily see the stock double, if not go even higher than that, if they actually show that they can make progress with their turnaround. But ultimately, I expect Groupon to not be here in a year or two. I think they've been for sale for years, and they haven't been able to find a buyer, obviously. Who knows if it's a result of the price, but there's no real reason for Groupon to be a standalone company. And I would expect it to to go away. So that's Groupon. The next thing we'll talk about briefly is Dell. And obviously Dell had some great news a week ago or 2 weeks ago, where they announced the official spinoff of VMware. And it kind of played out exactly as I thought it would when I did the video on Dell back in January. Dell was trading at 72 when I did the video in January, and now it's trading at 100. So I consider that a pretty amazing return for something that I thought was a rather low risk. I have sold about 2/3 of my Dell. It's still a low double-digit percentage. And the reason why I've sold it is because I think the large gains have played out. Basically, right now you're looking at a Dell Core that's trading at $40 a share. If you adjust for the VMware dividend that they're going to be paying out to both VMware holders and Dell holding company. And VMware is $135 post the dividend. So I think Dell at 40 is too cheap. That's less than 10 times free cash flow. And there'll be a very clean balance sheet. So you'll have a situation where in 2022, Dell can start returning capital or doing M&A or whatever. They'll be like levered at probably 1.5 times EBITDA. So you'll probably see something like a dividend put in place. And so I think that can go up to maybe 50, even up to 55, something like that. And then on VMware, because of the mechanics of paying the dividend out, 135 based on whatever their actual earnings power is on a 2022, 2023 basis. Currently their earnings are impaired because they're transitioning from their legacy business to their more higher growth SaaS business. And I think that also has upside, a pretty good upside from the 135. But look, I'm not really looking to be a fundamental investor in Dell or VMware. This is mostly a special situation that I've had for years. And with the spin announcement, like I said, most of it's played out. So I'll keep that low double-digit percentage unless it goes up significantly from here, and I'll probably exit all of it. I didn't like the fact that Pat resigned from the VMware board on Friday. That's rather odd. When they announced that he was leaving for Intel, they made a point to say that he was going to stay on the board, and that was in January. And now it's April, and he resigned. So my only thought there was it might have been because they were waiting for the spin to happen, the spin news, and then he was going to resign after that. But when they put the 8K out on Friday, it did not say it was not a result of disagreement with the board. It just said he's resigning immediately. And that's rather rare. They tried to put out an article through a third party, an interview that said he resigned for personal reasons. He said that, and that his time, is needed at Intel. But it didn't really strike me as all warm and fuzzy. I don't think that means there's something wrong in VMware, but it definitely means he probably was pissed about something, and that might have had to do with the way that the spin worked out. I don't really care, but that's my thing with Dell and VMware. I do think that VMware will also have a huge 2022. It's my belief, and I feel pretty strongly about it, basing it on nothing, that they will either be acquired in 2022 or they'll do a large acquisition. I believe this because they weren't able to be sold up until the spin for tax purposes at both EMC and at Dell. And I also think the only way Silver Lake and Michael Dell can actually capture their tens of billions of dollars is through an acquisition. They can't sell their stock in the open market. So they can get a nice control premium by selling to either a Cisco or an Oracle or a Broadcom or a Avenger, whatever the name of that company is today, that they can then liquidate whenever they want to without being an overhang to the stock price. I also think it'll be added to the S&P 500 next year. They can only be added, though, I believe, if Silver Lake and Michael Dell get below 50%. They're probably at like 55% post-spin. So the way they would do that is they would probably do a transformative M&A where VMware buys something. Again, VMware cannot use its stock as currency up until this spin because Dell and EMC always had to have 80% of the company, or else there would have been tax leakage. So VMware has a lot of things they could do now that they weren't able to do. And I think that's going to make it a very interesting stock in 2022. It's not really my thing. Again, that's why it's smaller. But I think both of those names, both Dell and VMware, will have very interesting 2022s. So that's that. Let's talk about PSTH. Obviously, vol has come down huge in this. The stock's come down and vol's come down. When I say vol's come down, I mean if you want to sell puts in it, you can't get as much money for them as you once could. And if you wanted to sell upside calls in it, those prices have also come down. And the reason for this, of course, is that as SPACs have kind of come out of favor, people are more and more concerned that PSTH will not be able to get a deal done. And that's why the stock has slowly gravitated closer to its cash value of 20, though it still trades at the largest premium of any SPAC out there. And the reason for that is there's no founder shares at PSTH. So there's no money being given away to Bill Ackman for the right for PSTH to exist. However, there is a huge warrant overhang where he gets, I think it is 6% of a post-deal market cap, effective market cap in warrants. And I think that will remain a huge impediment to getting a deal done for him. And I think you'll probably see him restructure those warrants, maybe surrender some of them if he ever plans on getting a deal done that's going to be massively accretive. His biggest challenge is that he only has a certain number of targets he can go after, given the $4 billion minimum he has to work with. And the people that he would be interested in all have other avenues to go public, and they definitely don't need his money, right? They're not kind of up and coming cash burning companies. That's not even the kind of thing he likes. So they could take an IPO route where they have no dilution from the warrants overhang, and they can stay private. Like Bloomberg's been private forever. Why does he need to go public? In-N-Out Burger's been private forever. Why does he need to go public? These companies are all self-funding with huge cash flows, and the only reason why they would go public is that they wanted to diversify from the founder so that they can move on. Maybe maybe the founder died and they need to de-risk the holdings for his heirs or for his trusts or whatever. And it remains to be seen how he's going to find a target. So the way I've been playing PSTH, which I think I've talked about before in here, I know I have, is I'm short a lot of 2250 puts. That's the only line item I'm short. No, I'm not short 25s anymore. And I'm short them throughout, all of the months basically. So your least risk with the shorting the puts is anything between now and the next 90 days, because in your worst case scenario, which I think is very unlikely, Ackman announces a deal tomorrow. The deal is hated by Wall Street. The stock goes right to $20 because people assume that this is going to break the SPAC buck, is what we call it. And the deal closes before your puts expire, your short puts. And then the next day, the de-SPAC stock is trading at 15 or 16 or 17 or $18, okay? That can't happen if you short puts in the next 90 days, because it takes at least 90 days for the SPAC to close its deal once they announce it. Generally, it's 90 to 120 days or more. So I'm not worried about that scenario, because I don't think Bill Ackman is going to destroy value, given the fact he's going to put up at least $1 billion of his fund's money into this SPAC at $20 for whatever deal it is. And I also think he's a good investor. And it's unlikely to me that he's going to do a deal for deal's sake to destroy value. So I'm short 2250 puts, not so much anymore with May and June. Those are pretty much worthless. But I recently put on August, and I've been short September for a while. So August and September are my two big strike months. The other half of my position at PSTH, which I've talked about before on here, is I own a lot of buy rights and I own a lot of conversions. So this is a little bit confusing, but I'll try my best to explain it. With the buy right, I bought the stock. This part's not that confusing. And I've sold December 30 and 35 calls against my stock. And the reason why I've done this is I believe, and Bill Ackman's told us, that if you own PSTH, once they announce a deal for PSTH, you will have the right to participate in buying PSTH2 at the unit price of $20. He hasn't said how many you're going to be able to buy, whether it's a half a unit or 1 unit. He hasn't said how the mechanism is, how it's going to work mechanically, but it's my belief that it'll be some form of right that's given to you. Obviously, some form of right, but I don't know whether you get the right the day they announce the intention for the target for PSTH1, and if it will close on the day that PSTH1 closes its merger and de-SPACs. I think the more likely scenario is that if you own PSTH1 through the merger, so you vote for the merger of PSTH1, then you will then be given the right to buy PSTH2 in a very small window, so that he has PSTH2 available for him to find his next target. the way it works with the buy rights and with the conversions, what a conversion is, by the way, is it's a riskless trade. So you buy the stock and then you simultaneously buy a put and sell a call at the same strike. So effectively, you own the stock, which is a delta of 1. And then if I buy a put, a $50 PSTH December put, and I sell a PSTH December 50 call, that is a delta of -1. That's the exact equivalent of shorting one share. And I have no net exposure to PSTH. All it costs me is whatever the cost is for that conversion, which for me has been about 15 cents. So it cost me 15 cents to put it on. And then I'm paying borrow costs on the whole trade. So since I'm using the $50 put and call, the overall cost of the trade to me is $50.15. And I am borrowing money to put this on, and my carry costs are like 75 basis points a year on Interactive Brokers. So I'm paying like 6 cents a month for this trade. I know this is pretty confusing, but anyway, the moral of the story is I believe that as long as the rights I get for PSTH2 expire before those options expire, which is December, then the options will not adjust for the rights. And I will capture all the value of those rights in this conversion and in the call and in the buy rights. So if you assume PSTH2 the units trade at $24 to $25, currently PSTH1 units trade at about $25 plus, because remember, you get 1/9 of a warrant too in the unit. And that's not there right now in the PSTH common, that you have to add the 1/9 of a warrant for the unit. And you assume you get anywhere between a half and one right for each share you own. It's worth anywhere between $2.50 and $5 the right. So it's very valuable. And I'm only paying 15 cents plus a 6 cent a month carry. So the risk here is that he has no deal. We just sit around waiting, no deal happens, and I lose the 6 cents a month carry, and I lose the 15 cents I paid. And with the buy right, a little bit less risk there because I'm paying so close to $20 for the transaction, given that it's trading at like $24, and I think that the calls are trading like $3 or something, or $2.75. So I'm creating PSTH at $20.75. And yes, if there's no deal, I'm not going to make any money on this. But if there's a decent deal, I can make a lot of money on this. I can make the money up to 30 or 35, where my short call is. And I also have the opportunity to then participate in this rights offering, which could make me another $2.50 to $5. So the reason why I like these two trades in conjunction is that the longer PSTH goes without a deal, I keep making money on these short 2250 puts. And the only way I'm going to lose money on those short 2250 puts is if the market starts punishing PSTH for not having a deal and the stock gravitates towards 20. And that could happen, but it seems like it's kind of hanging out and enjoying the $24 area, $24.35, I guess, today. And I don't see it going below $22.50 anytime soon, but it's definitely a risk, and it definitely could happen. I'm willing to take that risk. And so far it's worked out great, selling the puts on PSTH. My next idea is a new idea, and I have to warn you up front, this is very risky, and I also know nothing about biotech or about this company. So with that caveat, let's jump right in. So what attracted me to this idea, and the stock is IMVD, Igloo, Matt, Voltaire, Tree, Immunovant. And I like it because in the early March, a 13D was filed by its controlling shareholder, Roivant, and they said that they were intending to communicate with the issuer to acquire all the shares they don't own currently, which is about 45% of the company. And they will offer some mixture of cash and stock at a premium, which is consistent with previous takeouts of minority interest by majority shareholders. So that piqued my interest. I didn't know anything about the company, nothing. And if you look at the chart, it's blown up. So it went from like 50 or 55 to 13 from January to March. And then you had this 13D filed by the controlling shareholder saying that they were interested in taking it private. They also said that they're going to go public first, Roivant, and they won't consummate this deal until they go public. So, lot to unpack here. Let's talk about why the stock blew up from 50 to 13. So there's only one drug here. The drug is called 1401, and it has 3 indications. And one of those indications, and they're all like in their phase 2 trials. I think one of the indications is about to start a phase 3 trial. And you can see the stock's done unbelievable over the last year up until the blow up. I think people are very encouraged and enthusiastic about this lead indication. But again, I know nothing about any of these diseases, and I know nothing about this drug. All I did was read a bunch of sell side notes about it, which of course they universally love the company and the drug. And I looked at the stock chart up until what happened in January. So I believe the drug is legit. I don't know whether or not the reason why it blew up is going to be fixed, but let me discuss why it blew up. So one of the indications was something called TED, thyroid eye disease. And I guess what happened was when they started taking this drug during the phase 2 trial, the cholesterol levels went up a lot. And then once they went off the drug, the cholesterol levels resumed to baseline. And they voluntarily paused all dosing in all indications while they tried to figure out whether this was a specific issue with TED or if it's a problem across all 1401 trials. And this was the early February when they announced this. The stock then blew up a little more in mid-February when they gave a very small update, and then they reiterated that they were pausing all indications. I think the market only thought they were going to pause TED or 2 of the 3 at the beginning of February, but then they said they were going to pause all. And then March 8th or March 7th is when the 13D was filed by Roivant that said that they are in possession of material information about the drug and that they are intending to make an offer to acquire the company. So there's so much to unpack here, okay? So first of all, why did Roivant issue this 13D? I think there's no downside for them, right? The stock was bidless and it went to like 1350 the day before they issued that 13D. So by putting the 13D out that day, they then have this baseline of 1350. They could say, well, when we announced our intention to acquire the company, we are going to pay a 50% premium over the unaffected price it was the day before 1350. We're going to give everybody $21. You guys should be thrilled because it was only trading at 1350 the day before, and take it and be happy. So of course, this is preposterous because the reason why it was trading at 1350 was because the company halted all of its trials, and we're awaiting feedback from the FDA and the findings of what they found about the cholesterol issue. And they've told us they are going to give us the feedback sometime in Q2. So we have a huge catalyst coming up. It can happen any day now, where they tell us what's going on with the cholesterol, whether the FDA has agreed with them to restart dosing in any or all of the trials, and what the kind of going concern of the company is going to look like given this cholesterol risk. I should note that this drug is being tested also in China with a partner, and they've shown, not a partner, excuse me, someone that licensed it for China. And they have seen no issues with the cholesterol across all the different indications that they're testing. And there's also been some other companies that have a similar mechanism of action for this drug, and they've also had no cholesterol issues. So it's very likely this is a TED-specific cholesterol problem, and doesn't even necessarily mean that they can't dose in TED. It might just mean that it can't be dosed for older people or people that have had high cholesterol baseline, and maybe you have to use some sort of statins or something to statins? Is it statins or statins? I know nothing about healthcare. In order to monitor and to deal with the cholesterol. What I think is going to happen is it's going to play out 2 ways. I think first what's going to happen is you're going to get them to tell you that they're going to have a going concern here, that it's not going to be a 0, but that's a risk. There's a risk that they come back and they say this drug cannot be used anymore in any indication. If that was the case, it'll go down to $2, okay, with below cash. I don't think that's the case. So in the blue sky scenario, they say that they're going to restart all 3 trials, including TED, and the stock maybe pops into the 20s, maybe upper 20s. In the more likely scenario, they say they need some more time with TED and they restart the other indications. And I still think the stock goes into the low 20s there. But then what happens with Roivant and their 13D? I think you don't get any progress there until you have, of course, this resolved, or at least publicly they tell us what they're going to do, right? If Roivant knows now that the FDA is going to be fine with them restarting all the trials, Roivant can't buy the company for $21 a share. So make no mistake about it. Once we get visibility on what's going on with the drug, then they'll let the market know, and then they will have to use that price as the unaffected price for where they have to pay a premium to buy the company. So I think there's a high likelihood that they do end up acquiring the shares they don't own. They'll do this because if they want to go public, they need to have a clean structure. And this is the only public company that they have outstanding now. They used to have a couple other public company subsidiaries and they sold them. So they want to make it clean and simple, even though nothing's simple about Roivant because they have like tons of subsidiaries, but they're not public. So this will be a small for them. It's like a big company, $6, $7, $8, $9 billion market cap is what it will be when it goes public. And they'll probably have to pay maybe $1 billion or something to take out the minority they don't own here. I own common here, and I also own a variety of call spreads in I own a very small amount in May, but I own a lot of July and a lot of October. And I think you can get a real asymmetric risk reward there in kind of a 20-25 call spread or a 20-30 call spread. And I like it a lot. Again, very risky because it's a one drug company that currently has halted all their trials voluntarily due to this cholesterol issue. And if cholesterol issue dooms it, then it's a zero. I just don't understand why on March 8th, a full 6 weeks after they halted the trials, you'd have Roivant put out this 13D saying they want to acquire the company and they have material information on the drug. If we were really concerned about this company being a zero. Oh, I forgot the other really interesting part is that last May, they issued all of their annual options in stock to their executive team and the board. And guess what? They did it in March this year. So, and they did it at $17 a share, the strikes of the options. And, you know, I'm no fool, but I'm pretty sure if they thought that it was going to blow up again, and this was, 7 weeks after they halted the trials, they would wait till May to issue all the options in the stock compensation after they blow it up, and then not pull it forward 2 months to give them these large $17 strike options and some equity compensation at that price. So that to me is a huge tell that it's likely to come in the next few weeks, and it's likely to be positive when they give you the update. And finally, I was going to talk a little bit about MagnaChip, but just very briefly. So I own MagnaChip before MX, ticker MX, before the deal happened. It just recently got announced it was going to be acquired for $29 a share in cash by a Chinese private equity firm. It's now trading at $25.35. For some reason, it's down 2% today. And I think it's one of the more interesting risk arbs since Tiffany, which I talked about last year on here. And this has way less hair than Tiffany. So people are worried that Korea is going to block this deal because it's a Chinese buyer for a South Korean, I almost said North Korean, for a South Korean semiconductor company. And I don't think that that's likely at all. But even if South Korea does block this deal, if you go through the proxy that came out just last week, you can see there were 5 other very interested parties, all willing to pay in the mid-20s for the company. And it was kind of a rush process. So I believe that if the deal breaks, and the deal breaks 6 to 9 months from now, you'll get a $2 break fee, because that's how much you'll get if South Korea blocks it. So whatever they were willing to pay for the company, back in March, add $2 or tax affect it, because that's just pure on top of it, new money you're going to get. I believe that if you look out a year from now or 9 months from now and you started the process again, you of course have a year of cash flow and growth that you didn't have when you did the process back in February. So that's worth another $1 to $2, honestly. So now you have $3 to $4 of added value on top of where you had bidders earlier this year willing to pay $25, $26, $27. I think the second bidder was willing to pay $27.50. It's a good company. So they should have $9 to $10 a share in cash at the end of this year and no debt. And it's a $25.40 stock. And they should do about $1.30 to $1.50 in earnings and free cash flow next year on a $25 stock with $10 a share of net cash. It's trading like 10 times and it's net of cash, and it's going to grow at double digits. It's probably worth 100% more than that, adjusted for the cash. So I like MagnaChip in a break. I feel like Dr. Seuss. I like MagnaChip in a break. I like MagnaChip. I don't know how to rhyme though. But if I could rhyme, I would tell you that I like MagnaChip in any scenario that happens, whether it gets done at $29 or whether or not it breaks and we own the company for the next year and they figure out what plan B is going to be. And if plan B is them just being a going concern, that's fine. They'll return a bunch of the cash to us. They might even take on a little bit of debt, pay a big dividend, and we might even end up better off than we would without the deal happening. So my biggest two positions are Groupon and MagnaChip. And I like MagnaChip also because I think there's not much macro risk with it since it's an all-cash deal, and I think it's trading with a huge margin of safety from a valuation perspective. So in this environment, I like it. I like it a lot, and it's big. But you see it's down today. I don't even know why. It started going down after Korea was, in the middle of the night. So these things trade pretty volatile based on articles and based on what local politicians say and so forth. It's not that big of a company. So the odds that this would create a lot of waves in Korea to me seems low, but anything could happen. So that's MagnaChip. All right, let's see if we got any questions. Not a lot of questions. For the conversions, what months options did you choose? July 2022. No, for conversions, you have to go really far out because, July 2022 is okay. The problem with that is that you want really high strikes. Because if you don't do really high strikes, then let's say Ackman announces a deal and the stock goes to 35 and you did a conversion with a 25 strike or a 20 strike, your call is going to be exercised before the rights expire. It's a little bit confusing, but basically you need to go the highest strikes you can do. So with December, I chose December 50s. And with January 22, I did January 45s. Something like Interactive Brokers lets you actually put in a conversion where it's done all as a combo, and all you have to do is enter the price you want to pay for it. So I would not recommend legging into this. You can't leg into a conversion. You should do it all as one combo, or else you're going to overpay for it. And if you don't understand conversions, just don't do them. It's not worth it. But you can Google and try to learn about it that way. How do you find targets like MX, Dell, and IMVT? I don't really, one of the ways that I find ideas is through briefing.com, and I read In Play every day to see any kind of things, any news that's happened that day on In Play. The other way is through Twitter and through Value Investors Club. I don't really invest in too many ideas. With IMVT, that's what happened. Briefing had a blurb about Roivant offering to buy the company and 13D, and then I saw the blow up and immediately, struck my attention. With MX, a friend of mine pitched it to me a long time ago when they were in the middle of a process to sell one of their divisions. And with Dell, that goes back 3 years when DVMT, which was a tracking stock, Dell was trying to steal it. So I read, this was just kind of well known when it happened, and I saw that Dell put out a 13D saying that they were looking to acquire DVMT, and the stock blew up on it. And I was fast. I like a lot of hair. So the more hair has something, the more interested I am in it. With Tiffany, it was the same idea. Tiffany wasn't interesting to me until the deal broke. I mean, don't get me wrong. It's great to have an ARB where you can make 10% or 12% gross. But the deal had to break for it to really be interesting. Though there was a lot of hair in that once LVMH said they were thinking about breaking the deal. And that's when I got involved with Tiffany. So yeah, people give me ideas. I don't really buy that many stocks. And I don't really like buying crowded ideas, I guess. With Groupon, I just followed the name for years. And then after the reverse split happened in last June and the stock plummeted and I saw the huge insider sale in June, it just got me really interested. And I thought that when I started buying Groupon, it was a $500 million market cap. And I thought that this would be worth well more than that to an acquirer based on the amount of cost cuts you can take out if you put that business together with another company. I talked a lot about this in my first Groupon YouTube back in last fall. So yeah. Have you ever considered buying back some of the PSTH calls if a lot of the vol is bled out? The only, Kevin, the answer is no. It's a good question. I am very skeptical that Bill Ackman could create the kind of value people think he's going to create with PSTH. So for PSTH to trade at $30, $35, $40 a share would really be a Herculean task. because you're talking about a huge market cap now that's going to be a much bigger market cap post deal at $20, pro forma. So for it to go to 30, 35, 40, you would need kind of a GameStop, hyped mentality for it. And I don't want to bet on that. So I much rather have the short calls against my common so that I have that security to where if no deal happens and it goes down to 21 or 22 or 2050, I don't lose a lot of money. I have no interest in speculating on SPACs for the most part. And I have no interest in speculating on SPACs trading above cash, right? I own a few SPACs now, all pre-deal, all pre-announcement. They all trade below 10. And, I won't lose money if they don't announce a deal. But other than that, I don't like SPACs. I don't like anything about them. So it's hard for me to just be naked long. I would just be naked long PSTH. And I don't want to own PSTH at $24.50 with $20 a share in cash. It doesn't make a lot of sense to me. Any other questions? Comments? Anything? Any rumors on BMYRT? Nope. I mean, unfortunately, we are in a information vacuum with BMYRT. At some point, I would think soon they file the lawsuit against Bristol Myers. I would think that happens. I would think within the next, if not the next month, and then it's really just a question of waiting and praying. And I say praying, it's not that I don't think we're going to get paid. It's that I don't know when we're going to get paid. Bristol Myers is going to have to want to pay $4, $5, $6 right now, I would think, for the trustee and the large holders to agree to it. Maybe they would get away with something in the threes, but Bristol Myers has all the luxury of time because, this thing could take years. So I'm still very, very bullish on us getting paid there. And I just don't know what the recovery is going to be and when it's going to be. But as soon as the lawsuit comes out, I'll gladly do a YouTube discussing the lawsuit, though we know what it's going to say. I mean, what's up with your Twitter plans? That's a great question. So for those of you that don't follow me, which is a lot of you, I am strongly considering opening up my Twitter account. I'm transitioning some people that are currently on there to another locked account for kind of things like that. And then I'll open up my Twitter account and I'll be much more, I'll be available to meet new people, and I'll be less transparent than I am today on my current Twitter account where I tweet every trade, but I'll still tweet ideas and I'll still tweet some positions, things like that. I don't know when I'm going to do that. It could be this week. It could be next week. It might be never. But if I do open up my Twitter account, I will definitely do another YouTube to introduce people, I guess, to me and to my background and to my investment philosophy and so forth. But yeah, I'm kind of excited to meet new people. That's kind of why I like doing YouTube, because I get to meet new people. So it's the same thing. Can you talk through NVAX? So I was long some call spreads in NVAX. Some people that follow me know this. Wow, look, it's up a lot. Wow. And I sold them I made a bunch of money on them last week, and I sold the balance this morning, unfortunately, because they didn't announce the data for the interim trial that we're waiting for. And unfortunately, I don't have much views beyond that. I mean, I assume NVAX is going to have a positive readout in the U.S. trial, and I also assume that from a safety perspective and an adverse effect perspective, it's going to be a more tolerable vaccine than the Pfizer and the Moderna vaccine. So I think NVAX has a chance of really working over the next few weeks. I don't understand why they haven't reported the data yet. I do not own NVAX, and I have no intention to get back into it, but that's why I did own it, and that's why I own call spreads in it. So I hope it works for humanity and for my friends that own it. But yeah. Why do you like call spreads versus calls? So yeah, it's a great question. So the reason why I've always been really obsessed with call spreads versus calls is two reasons. Usually when I buy, the names I like generally speaking, are not stocks I think are going to go up 4, 5, 600%. I'm not buying techie growth names that I think have huge upside. So I can give you an example with each one of my names, how this has worked out. And it's worked out really well. So let's use Dell for an example, okay? Dell's a good example. I owned actually just leaps in Dell for a long time. But last summer, I put on 2 different sets of call spreads. I put on, I think it was last summer, I put on July 60-70 spreads, and I put on Jan 23 90-100 spreads. And I didn't put them on at the same time, but I paid like $1.50 for each. So the idea behind this one, and the stock was trading, I don't remember the exact numbers, but the stock was probably trading at like 50, 45 or something when I put the July 60-70s on. And when I put the 90-100 Januaries on, I think it was trading at 70. I think something like that. So I paid like $1.50 for them. So the thought process behind that is I never thought Dell was going to go to 150 or 140 or 200, anything like that. I thought there was a pretty good opportunity for it to go to 100 to 125 by January OpEx. And for me to put up $1.25, or excuse me, $1.50, and then make $8.50, so 600% return on my capital, when the stock only had to go from 70 to 100, which is a 50% return, I thought that was extraordinarily more attractive than just owning common. If I bought calls instead of buying call spreads, those 90 calls might have been like $5 or $6. And the way the equivalent trade would have had to go to, the Dell would have had to go to 120 or 125. And then above 125, I would have made more money owning the 90 calls versus owning the 90-100 call spread. So every time I make a decision about whether I want to buy a call spread or a call, I think about it like that. And I didn't have extreme confidence Dell was going above 125, but I felt really good it can go to 100 based on the huge margin of safety and the sum of the parts. Groupon's another perfect example. So with Groupon, when I put on the 90-100 Jan 22 call spreads last week or 2 weeks ago, 3 weeks ago, I paid 75 cents for them, and they'll be worth $10 if Groupon's above $100 next January. Then the Groupon 90 calls were $3 at the time. So I would have to get Groupon above 130 versus 100 to have the same return on owning the Groupon 90 calls versus the 90-100 call spread. And I don't think Groupon could be 130, 140 next January, but I don't want to bank on that. I think there's a much better chance of it being 100 than being 130, 140. But there's also a practical reason why I do the call spread versus the calls. In almost all the names I own, the spreads between the bid and ask on the calls are very wide. So if you look at Groupon, for instance, and I'll show you, I'll give you a practical example right now with Groupon. So if you pull up Groupon and you pull up the January options, January 22 options, you could see that I have the wrong month here. You can see that the 80 calls are 194 by 255, and the 90 calls don't even have a market. They're 15 cents by 209, okay? It would be pretty hard for me to get the middle of that 80 call. Just call it, bid 220 or 210 and get filled. I probably would have to pay much closer to 230 or 235 or maybe even 240 to get filled in that 80 call. But when I put on the call spread and just the mechanics of the way market makers work, I tend to get filled at the mid or even better when I put on a call spread in some of these very out of the money names. And the reason why that is I'm kind of selling vol. I'm not buying vol. So the market maker doesn't feel as exposed when you put on a call spread versus putting on a call. But that's why I do a lot of call spreads versus calls. The other thing I really like about call spreads, and this worked out perfectly with Groupon so far with me, with my Jan 21 calls spreads that I owned and my April call spreads I owned, is that as Groupon goes up and goes through the top of my call spread, my exposure naturally gets smaller. And that is great, right? When a stock goes up and it's more expensive, you usually want to be smaller in it. Now, yes, it might be a better value at 45 than 25 if they're really executing well and they've done things that you weren't expecting. But for the most part, when stocks go up, I want to sell. With the call spreads, as the stocks go up, my exposure just gets smaller because my delta adjusted exposure for those call spreads goes down. And once they expire, hopefully in the money, they come off completely. So that's why I do call spreads pretty much across the board with all my names. And I did it with IMVT too. And again, the example there is I don't have a strong opinion that IMVT is going to be $35, $40, $45 anytime. I mean, it could, but a lot would have to happen for it to get to that level. And I am more confident that at 25, 27, 30, that is where it could go to over the next 6 months, right? I think that they might get taken out at $30 or $25 from Roivant. And if I can maximize my call spread at 6-1 or 7-1 or 8-1 return versus, just buying the call, if I bought the 20 call, then I can't maximize that, right? The $20 October IMVT calls are $275. And if it got taken out at $250, I wouldn't even make double my money. But if I own the October 2025 call spread, I'll make 4 or 5 times my money. So that's the reason why I choose call spreads in this situation versus calls. Do you have an upper limit on percent of portfolio for call spreads on a single stock? No. I would say that with IMVT, I have about 150 basis points of exposure on call spreads, which is a lot. I mean, that'll be worth 0 if it doesn't work out. And I have them over July and October spread months. But I'm comfortable with losing 150 basis points. I mean, we all know how big I made BMYRT, right? I mean, I lost a third of my capital basically on that. So 150 basis points, especially when you could write off your losses, is only like a 75 basis point after-tax loss. And that 150 basis point call spreads could be worth 750 to 1,000 basis points in my portfolio. So it's a huge possibility with a small amount of capital put up. But I don't make call spreads like 500 basis points or anything like that. Though with Groupon, I have a huge amount of capital exposed to Groupon call spreads. But most of those are in the money. They've already worked, and I'm just waiting for them to expire. For the Groupon very out-of-the-money call spreads, the 80-90s, the 90-100s, that also was only like 150 basis points. But that 150 basis points could turn into 1,500 basis points. So that's the kind of way I look at it. I want huge asymmetric return and kind of do it over a few different names. Any other questions? All right. Take care, everybody.